with Mutwale Munyumba. For those of us, of course, who are able to just get us live on Facebook, of course, we're equally getting live on social media, Twitter, Facebook, as well as Instagram. Mutwale, how are you today?
I'm fine, thank you, Vernon. It is a little bit of a behind the start, but you can never predict these things. Maybe it's what we call the V-Day hangover, Valentine's Day hangover. People who are just trying to figure out what life dealt them yesterday. Some guys slept on the couch. Some people were celebrated. We could see what was happening. We call them the last
Yeah.
minute squad. They either you were either happy or you were either distraught, but that's life.
Hmm.
So yes, we're actually getting into today's actually quite a big day. Sorry, there's a little
Hmm.
bit of feedback here. Today is actually quite a big day because it is Central Bank Information Day. And here we're actually waiting for the central bank governors, the central bank meeting today at we should be starting somewhere around midday. And the main things I want to travel through today, Vernon, are going to be some of the major. Sorry, the main thing I want to travel through today is going to center around the MPR meeting today, or the MPC meeting today, to discuss the potential moves in the MPR. Expectations will be that there will be no shift in the NPR directly, because the central bank has probably done its part, and they would like to see what impact their movement, what impact their price hike, or sorry, their change in the reserve ratio is going to have on the exchange rate. We have seen the exchange rate move a little bit, and we're going to start going into the markets just now. But just a quick feed for everybody. Please pay attention. Today is MPR day, while tomorrow is a bond auction. Always know that whenever you have an MPC meeting, you do have a bond auction usually just coming up the next day. They actually schedule those things to work in that specific way. So we do we do have, as I said, data coming through specifically around there. Now, starting from the FX rate, we did see that the FX rate closed at 19.34. Vernon, that officially means that the exchange rate is no longer that officially means now that the exchange rate is currently sitting at pre-election levels. So whatever gains that the current administration is lauding when it comes to the exchange rate, that's gone. It's absolutely gone now. And now we're back at pre-election levels of 19.34 in terms of the interbank rate. I know that that's not the rate some of you are paying, but that's not the rate we track. We track the wholesale rate, which is the interbank rate. So that's one piece of information that everyone should actually keep up in line with. So that being said, Vernon, one of the big things then that means is that a lot of these so-called confidence, unfortunately, which we are basically trying to hold on to, that has vanished. Well, that at least has now has dwindled away. So whatever confidence, unfortunately, our administration are trying to hold on to, as I said, that's pretty much gone out the window. Now, what does stand? What does stand is that the rand is still holding a pretty strong position. So I mean, the rand is still holding a pretty weak position from the year. So we haven't had a run up in the rand as well, because that would actually be catastrophic. Because remember that South Africa is where we do our imports from. So if South Africa takes a beating, then we're going to take one. Where if South African currency gets way too strong, which it slightly did yesterday, but if it gets way too strong, then it starts being problematic for us as a whole. So I think that's the key thing that we all want to just keep an eye on is the South Africa Zambia exchange rate, because that affects a lot of the simple goods that we bring in through South Africa. So you got a 0.1% movement up in the US dollar yesterday, which is not as bad, but it's, as I said, that 19.3423. That means that I said exactly that we're where we are pre-election. Then we had the rand. We had the rand movement of 0.84 upwards as well. It was a bit relatively stronger because they had a strong day of South Africa rand, but it hasn't run away because year to date rand is only up 1.74%, but year to date dollar is up 6.88%. So you can see the big difference between the two. South Africa has been subdued mainly because of the internal things that they're going through. Well, if you're looking at the bond index, we're seeing that the Zambian Kwacha bond was up 0.06%, while in USD it was down only 0.04%. So these two things together mild it out. In terms of the beginning of the year, since the beginning of the year, US dollars Bond index in US dollars is down 2.84%, while in Kwacha it's up 3.87%. Remember that it is trying to be the resistance point against the dollar losses itself. And then in the commodities market, we've seen that oil is currently sitting at about $84 0.67, down 2.27%, while copper is back up above 9,000 as of yesterday. Now, in order to check what has actually been happening in the news, let's actually check some of the major stories. Some of the major stories actually affecting the global economy before we go into our main story, which is 5 questions I think should be asked at the MPR, and to discuss what those 5 points should be at the MPC meeting. But we have seen that Asian stocks have been hit by tech rout. There has been a tech rout due to as sticky inflation ramps up Fed fears. So that was the big news from yesterday. So we're seeing that a lot of the risk stocks, because you see the first signal that we'll always see as Africans is how are Asian stocks doing. Now, remember, the big news yesterday was we're waiting for American inflation news. When we got into American inflation news, we found that there was a 5.6% inflation. It didn't drop down below 5.5. That was the expectation, and it was 5.7. So we're seeing inflation kind of hovering around the 5% mark in America. Now that means that the Federal Reserve is probably not going to push. Is not going to be on a rush to slow rates down anytime soon. The reason is this: the Federal Reserve is targeting 2 to 3% inflation, so they're not going to let up until. So interest rates are going to keep being aggressive until about that point. So that was a big point. Now core inflation, which is quite important. That was down 5.6%. Now, general CPI was at 6.4% when it was expected to be 6.2%. So it really is that American inflation is now starting to stick at a certain point, and that's what everyone is now starting to get worried about. And that was the market reactions from yesterday. The other big piece of news: America's inventory of oil moved up by 10 million barrels. That's what has pushed the oil price down by 2.4% because of the big U.S. inventory buildup. And that is another consecutive inventory buildup for the USA. Now, when we saw oil prices going up and away, it's because there were a lot of consecutive inventory slowdowns. Now we've had quite a strong set of inventory buildups with only one inventory drawdown this in the last 6 readings, and this is not even the highest one that was. At the beginning of the year, we had an inventory buildup of 14 million barrels. So this is actually what's creating a lot of supply slack in the oil market and might start pulling it down. There is a lot of US supply coming back online. So therefore, oil under pressure from against inflation and also an inventory buildup. So that's good for us. U.S. crude inventory is up 10.5 million barrels, and that exactly pushes the oil up and then pushes oil company revenues probably downwards. So that was the biggest major piece of news. Now, looking at some of the data points that we're expecting from today's reading, we're expecting CPI data has just come out of Saudi Arabia, 3.4% above, which is different from the 3.3%. Obviously, they control their oil, so that's the main thing that can keep their inventory. Data is expected to come out of Britain with PPI data. So supply chain inflation and consumer inflation are expected to come out of Britain today. German inflation is expected to come out today. Spanish inflation is expected to come out today. South African inflation is expected. Namibian inflation. We're expecting our interest rate decision, obviously, as well. But we're also looking at Botswana inflation coming out. So it's inflation reads across multiple countries coming out today, with mortgage data coming out of America and inflation data coming out of Nigeria. So this inflation data will tell us how the global trends of inflation are. But the leading one is in America, where we're seeing that there is a bit of sticky inflation. And one of the biggest ones we should keep an eye on is housing price inflation, expected to come out of China, the January housing pricing index. How has that moved? Because that affects housing demand and therefore demand for your copper, because Chinese construction is also a big customer of Zambian copper. So this will give you all the data that we're looking at. So a lot of inflation reads across, but we're still seeing sticky inflation. But we're seeing interest rates now just holding a specific point because they're not sure whether the Federal Reserve will will crank the screws or kind of let that go for now. Those are the data points that we're looking at today, Vernon, in terms of the market. Now, but our biggest news today has got to do with our central bank. and what our central bank is going to be up to today in terms of their rate decision. What is going to come of it? Now, the last decision, the central bank pointed out that they're not going to hike interest rates, but they were concerned about a few inflation risks that were on the horizon. And some of the inflation risks that were there were things such as regional food demand, which was set to push prices up, energy prices, which has wreaked havoc over the last couple of months. And this was in the November meeting. They were worried about energy prices and also the rundown of the currency from the seasonal factors of December when we were buying. Remember that November, December, January, February usually weakens the currency as well, because that's around the time we're dealing with farmer inputs. So we do a lot of activity with our FX rate. And then on top of that, you got Christmas coming in as well. So those were some of the concerns that they had. Now, recently we have seen that since the last time we met, since the last time the Monetary Policy Committee met, the currency has gone down by 16%. Month-on-month inflation is currently above expectations. So inflation is sitting above the expectations curve instead of in line with the expectations curve when it was in November. It shot up during January. That was the big jump up. Otherwise, inflation was actually staying subdued, actually, even in December. So in January, we've actually seen that first inflation spike, and we see another one coming in because of transportation costs and food prices. And especially the kitchen table, where we're starting to see grain prices moved up by about 20%, while simultaneously we're seeing some meat prices also moving up as well. In January, we saw a lot happening. So we have seen a weakening of the kwacha, rising of costs of living, but we also have seen industrial recovery. January PMIs showed that industrials were up by 50. And we also had an electricity issue as well, which threatened the growth of the economy, but seems to have slowed down. Though, Vernon, I'm actually in the dark myself at the moment. So as much as we say there's no issues, ZESCO visited us last night, and it seems as though they're trying to sneak load shedding in under the radar. Who can say? But however, you know these things. No, it's a fault. No, someone just switched it off. Right. Now looking into some other data quickly. As I said, looking into some of the information that we are expecting from today, here are 5 questions that I'm going to share that I feel should be dealt with. And if I was sitting down opposite the governor, here are some of the questions that I would deal with on a personal level. So take them down, people. These are things we should be looking for, but I doubt we'll ever get answers to them, unfortunately. But these are some of the things that I feel. Number one, the first question I would ask has got to do with what I call the Chimerica Rift, which is China and America and the battles that they're having. Over the last few months, Vernon, we've been seeing that as we're trying to get to a debt negotiation, you'll start to see Janet Yellen saying the Chinese must speed up. They're the ones who are the problem. The Chinese will say, well, the Americans are the problem. Why doesn't the World Bank take a haircut too? And then all of a sudden, there's a lot of this back and forth. Why? Because China and America are actually in an economic competition. So with the economic competitiveness rising between China and America, and words even being exchanged between the two, between even some officials between the two of them, how much do we see this dragging our debt negotiations and keeping our lending rates high? Because this is a question the central bank has to deal with, because lending rates currently are a function of, one, the LIBOR rates plus the country risk premium, and that's affecting the government bond rates. That will then affect the country's lending rates, because the government bond rates form the base of risk of what everybody else is able to get. So until we can start to get people comfortable with getting Zambian bonds at a lower interest rate, because the global economy is actually recovering in terms of yield hunting, we will have a struggle. And currently, what seems to be the barrier between all of this is China and America shaking hands and saying, we have agreed to kind of restructure this debt. And these are the terms by which we've agreed to do it with. And this is where the issues are coming about. So the G20 Common Framework, yes, it's up to America to try and sell that around the world, and they're happy that China finally signed on to it, especially through Zambia. But now the delays are starting to come between the two of them. You had President Biden even speaking about a spy balloon that was caught in American territory, and that is some of the tension that is keeping up building. And Zambia can easily become a battleground, if not already has become a battleground of China and America's issues. And also deglobalization and regional competition is also going to play out as well. So remember I said last time when I gave you my risks, is that in the short term, deglobalization and the Chimerica Rift is a problem But in the long term, it's an opportunity, but it requires that we're able to get through this. So as long as these two groups cannot get along with each other, we are going to have a problem sitting down, agreeing with one another. This is where the risk is actually coming from. So the first question the central bank would have to ask is, what is their outlook now? The expectation was by Q1 we'd have a resolution, and therefore interest rates would start coming down probably around Q2, Q3, because we'd be expecting that the global investors would start coming in, especially because they are showing appetite globally. They're showing appetite in Mexico, Indonesia, and corporate bonds in America. There's a strong debt appetite. So it means that whole interest rate problem may not play out for too long, and there is a risk now of them entering if you're a bond investor. So this question is actually quite essential. The second question that I would ask, especially in this situation, has got to do with banking profits. And the main conversation I think we had recently about banking sector profits. We saw banking sector profits and banking sector profit margins sitting at about 28% in terms of profit margins, and we saw profit growth going up 10% from a year where we saw 200+% of profit growth in the banking sector. So the banking sector currently has made 5 billion kwacha worth of profit. This is shocking to everyone. Those are huge amounts of money. So the question now is, with banking sector profit sitting at in 2021 and 2022 sitting at record levels, and the data indicating that this profit is not driven by an increase in lending, but it's driven specifically by an increase in government bond investing and trading. Okay, so in other words, lending to the government. The banks are not making money lending to the people; they're making money lending to the government, and therefore potentially crowding out the people. Or at least they've made a lot of their money lending to the government, and now their holdings from the government are quite high. The question is, does the central bank not see this, as economists like myself, as a threat to the social fabric of this country? And the reason I say this, Vernon, is this seems to be stimulating inequality. More than it's stimulating growth, it's stimulating inequality, because banking profits without lending expansion and without access to capital for many people means a specific corner of the economy is making a lot of money while the rest of the economy gets iced out. Yes, banks have started lending more to small businesses. Those numbers have started to pick up. Banks have started lending more towards even individuals. We saw that loans towards households have gone up as well. And that maybe that can finally start to turn the tide. But right now, seeing that level of margin and that level of profit and that level of excess sitting in the banking sector, a sector which is usually taken care of by the central bank. And my big concern, I think, for this, Vernon, is one, a lot of that huge profit was basically financed by the central bank. Because if you look at a line called refinancing credit, revolving credit by the central bank, you find that's a huge expansion, by the way. That line was a big expansion. Okay, so in other words, the central bank has been lending money to banks who then go and lend money to the government. Okay, and that's where the problem is coming from. All right, and then the banks are making huge profits. The central bank is the only entity charged with the ability to create money in this economy. So basically, we finance banks to go and become rich and famous, and then at the same time, it hasn't extended to the general economy. It's money sitting in the hands of the government, unfortunately. Now, this current administration has at least slowed down in its lending, because we saw that our new loans to the government have gone from 8 billion kwacha down to about 2 billion kwacha this year. That's at least an improvement. And then simultaneously, we've also seen that the government bond stock has not increased much. It's actually stayed relatively flat. But my worry, Vernon, is when you start seeing bankers making that much money and the rest of the economy maybe not being included, you start having these fights between professionalism and populism. Okay? So that's where the problem starts coming from. Where you, Vernon, who's feeling like you're outside the system, now go to the ballot, you vent your frustration, and you vote in a populist who's going to promise to give you everything because you're frustrated that the professionals give you nothing but excuses and stories. And this is what professionals have to stop doing. Professionals, unfortunately, in Zambia, the professionals have to stop now getting down to this thing of giving people stories and explanations and theses when the people are busy asking for results. this is where the problem starts to happen for many of them. And this thing of bank profits being high while capital access is still constrained, while interest rates are still sitting in the 20s and interest rates are still sitting in the 30s, and we haven't seen enough capital get deployed out, will be an issue. Now, yes, it's good to see that mortgages doubled, in fact, tripled in the last year. It's good to see that business loans to manufacturing and business loans to mining have all gone out, but a lot of that is still sitting at the top. So credit expansion needs to be very carefully monitored, and to make sure that as much incentives are given to the banking sector to get loans to the bottom. Yes, we keep seeing a lot of handshakes. We keep seeing a lot of activities happening. We keep seeing a lot of this and that, but we're not seeing enough of the actual results happening at the bottom of the economy. So we need to make sure that our SMEs are at optimism level, and we're actually seeing that as many of our businesses are creating work for our citizenry. So what we want to try and avoid is the bottom of the economy now becoming populist, because the professionals are failing to answer the questions of the people using the professional techniques, and banking profits being so disconnected from the reality of a lot of people's lives might be a big issue that we have to start addressing. Now, maybe this is why the central bank has actually decided to act and decided to step in and say, look, we're going to try and rein in some of this activity because it's now affecting the population. The reason I say this, for the reason I'm focusing on this point, is because if you're going to have banking sector profits rising, you should have real wages rising. So last year in Zambia, real wages moved up by 0%. Okay, the purchasing power of a salary moved up 0% last year. However, the bank's profits moved up 10% and have stayed elevated. And the revenue that they're generating from areas such as bond trading is then alarming to a lot of people. So should you have the real wages of a country sitting so still while the banking profits are still getting stronger and stronger? The average salary of a person grew by 9.8%, while inflation grew by 9%. So that is what I mean when I say that real wages did not grow at all last year, and that's part of the struggle that everyone's having. The third question, which we want to try and maybe have to the central bank, is non-performing loans at record lows. Now, non-performing loans for the first time are recorded as at the lowest they've ever been, as far as we've been taking records, as far back as 2006. And it's common knowledge that in 2021, you had a bunch of government contractors who were given government securities in order to make sure that they could continue supplying the economy. Okay, they were given government securities to make sure that at a time they were under financial stress. And a lot of these were fuel and fertilizer. A lot of these were fuel and fertilizer suppliers, especially during election time. And as they were under financial stress, they were given financial instruments, things that they could trade off should they need liquidity and at least some form of payment. Now, the government specifically gave out long-term bonds, your 90 billion, your 15-year bonds, your 15-year bonds, your 10-year bonds, your 7-year bonds, but really your 10 and your 15-year bonds were the ones issued out to a lot of these people under private placement. Now, as a remedial measure, that was actually put out. Now, especially during it was a time when there was fiscal constraint. Now, however, at a time when we saw the non-performing loans drastically drop, the question then about non-performing loans sitting at 5%, is that a sign of a better performing economy where people are now able to service loans, or is it a sign of a bailout? Because this is also what people are questioning in America. When bank balance sheets were sitting so strong in the recent stress tests, is it a result of a better economy, or is it a result that the Federal Reserve in America stepped in, bought off a bunch of toxic credit, which was packaged into bad financial instruments, and it's now sitting on the balance sheet of the central bank in America, as opposed to on the balance sheet of the banks who are looking healthy and don't have to hold those toxic loans? So effectively, if I go in and I give a person who has supplied fertilizer a 10-year government bond or a set of 10-year government bonds and tell them, look, you can cash this in if you want, go to your bank and cash this in if you want, or you can hold on to it and get paid later. Now, this fertilizer supplier decides, I need the cash, sells it to the bank. So the bank no longer has a non-performing loan. His loan is gone. They have transferred that loan into a government bond, okay, which is seen as close to cash. It's seen as secure. So this improved the bank balance sheets by transitioning the 5 billion kwacha of non-performing loans into a couple of extra billion kwacha of government securities, which have now started to look stronger and stronger, okay? So how much of NPLs in 2021 coming down and NPL sitting at record lows in 2022, how much does it have to do with the government contractors liquidating, or is there strength in the lending industry? And does the 5% speak to an improvement, or is it just a result of a bank bailout? Because effectively, when you start giving contractors government securities that they liquidate, and then the government and the banks start holding government bonds, that, my friend, is the definition of a bank bailout. Okay, because the banks were holding these toxic positions which could have run them down. And now the government basically gave them government securities, which now they can utilize and they can hold with definite cash flow holding to them. So that's a big concern. The question then is, what is driving the strength of lending? Because this is part of what the central bank's conversation should be about. Because is too much money going on? Are strong bank balance sheets the time to be tightening? Okay, or are the bank balance sheets strong because you made them strong? You and the treasury made them strong, and now you want to try and point them out and say, look, the balance sheets are strong, we can start to squeeze. Maybe these banks haven't tightened up yet. Maybe these banks haven't actually fixed what's going on yet. Now, finally, so the fourth question, which we would take into the central bank meeting, has to do with the forex rate. And we said that since the last meeting, we've seen the US dollar get 16% stronger, and the kwacha enter its second longest streak since 2000, since on record since 2006 of 92 consecutive days. Now, the longest streak is 20. The longest streak was in 2021, 2020 going into 2021, which ended in about May, June, where we had a 200-day streak of kwacha losing value against the dollar. So even with the central bank taking action now by selling dollars into the economy, the dollar is still gaining momentum. Okay, and now it has slowed down in its momentum slightly, but it is still getting stronger. So is it not time maybe to consider an alternative method of stabilizing currency? And when I'm talking about alternative method, I used to be, as I was a bond trader a while back, one of the things we also saw coming up was a forex derivative market. In other words, where people could buy and sell futures contracts for forex. And this could actually help stabilize the market. Now, the unfortunate thing with that was banks work very well when information is not perfect. This is the unfortunate thing. Our banking sector does very well when information is not perfect because those asymmetries in information allow them to make money. So let me give you a simple example. If you are trading maize, let's say you're a briefcase trader of maize. You know that the maize farmer is going to sell it to you at 100 kwacha a bag. And you know that the milling company wants to buy it at 160 kwacha a bag. And they don't know each other. The milling company doesn't know what the farmer is selling and what the farmer is selling at. And the farmer doesn't know what price the milling company is selling at. This is how briefcase traders generally work. They go in there, get the information from both sides, don't tell them a thing, and make the difference. So this is what we mean by asymmetric information that's benefiting banks. They know what the supply and the demand side for FX are. They know how the cash flows for FX are going to look, and they use that to their advantage in terms of their FX trading activity. So in the end of the game, if we don't know the future prices and the banks are now able to control that level of information, then they get to profit as much of it. So they are resistant to a lot of these innovations that can help currency markets become more open and transparent because they don't make free profits off of it. And unfortunately, in this country, we've encouraged a lot of people to make free, cheap, and easy profits off of many things. So one of the things we need to start asking for is, should we not start having derivatives market for FX back? Should we not have the central bank support such activities so that we can have a much more open and much more stable environment? Because if we can have those futures contracts on dollars, in other words, somebody can say, look, I'm going to be selling dollars in 6 months, and this is the rate I'm going to be selling. Who'd like to buy this contract? And therefore, now a contract has been put together in 6 months' time or in 12 months' time. And therefore, the futures price is determined by the market and not determined by the people who are sitting in the back office of banks, okay, who can literally wind up somebody as easy as possible. Okay, so that's what you're trying to avoid. So you don't want futures contracts and forwards contracts sitting in the control of the bank, but you want those prices also market controlled. So you want the futures market not to be sitting in terms of the treasury deciding how strong it should be, but it should be sitting in the hands of the market operations to be able to see what prices should be prevailing. So previous attempts have been there. So should we not be moving towards a futures market regime? And should we this time not have banks become the ones who put spanners in the works there? So that's the fourth question I would ask. And finally, the fifth question I would actually have brought to the central bank is this to do with green lending, green energy lending. And so basically, our recent battle with load shedding showed that the electrical grid of this country is under stress, and that is a risk to economic growth. And also, if these businesses are not performing, they're not able to service their loans. So energy market data has shown that a lot of this was brought on by 50,000 households being connected to the grid annually, and the domestic sector contributing to 58% of the nation's domestic grid demand since 2014. So as a nation trying to export electricity and also trying to grow our mineral sector by threefold or fourfold, we need to try and find a way not to only build new power stations, but also to take as much of the domestic sector off the grid without compromising their ability to get electricity. However, we've talked about this before, that going off the grid will cost you anywhere from 60,000 kwacha to 120,000 kwacha, which then will require financing, because not many people have 60 to 120,000 kwacha just lying about doing nothing. So the question then is, what tools does the central bank have at its disposal, okay, so that it can go in there and ask, and maybe either encourage banks or drop rates? What does it have at its disposal to be able to get banks to finance at single-digit rates or even lower, at least single-digit rates or very low teens, the interest rates for somebody to be able to say, I want to take my house off the grid, for somebody to be able to get a 14%, 12%? What tools does the central bank have so that we can have a growth, we can have a sustainable economy which can grow without the risks of load shedding coming back and forth constantly? Because I don't see this load shedding being the end of the story, because we have grid stress. In as much as people say, no, it's got to do with Kariba and water, it's grid stress, okay? We have a stressed grid, and every time there's economic activity happening, we drain the water from that place. So if it slightly doesn't rain enough, then you start to see that it starts to affect our ability to generate electricity. And those people are 5 questions that I think should be asked at today's monetary policy meeting. And with that in mind, I think those are the main concerns that we're going to try and voice today. I don't know if we can finally have Vernon back and see if he has any thoughts before I give you my last words. I think we'll see if we'll have him back at another time. And I'll give you my last words regarding our wealth management. And I think this has to do with just a few of the wealth trading issues. So yesterday, I was giving you your 5 levels of wealth, and I just wanted you to revise into that what your thought pattern was. I know a lot of people may not have picked that up, but yesterday I did give you what I call my 5 levels of wealth. And I'll just go through these one last time in terms of my wealth targets. Sorry about that. Let me just give you the correct one. I was giving you my 5 levels of wealth, what I call my 5 wealth targets, and what this means in terms of investing, for your future. So I'd given you these 5 wealth targets in terms of financial stability, strategy, security, self-reliance, and self-determination, and how it goes from just having a budgetary surplus, being debt-free with the 6-month reserve, to having 5 million kwacha worth of financial assets that can generate 5 times your basic needs, giving you the ability to pursue your wants, dreams, and some of your aspirations. And just to warn everyone that, look, earning about 40,000 kwacha, 50,000 kwacha a month is already putting you in the top 0.5% of the economy in terms of earners. So that already gives you a breakdown of what we're looking at. And these were the numbers that people should have in terms of the amounts of money you should be investing on a monthly basis in kwacha if you want to attain security, reliance, and self-determination by age 60. And if you tell yourself you want to retire in 10 years, and that may not put you at age 60. So what you want to do is look for the number that is before that. Look for the number that is 10 years. So if you're saying 10 years, do you have the ability to invest as a 50-year-old? And this is assuming you start with zero. And if you look at also the recommended lump sums, this is in thousands of kwacha. These are the recommended lump sums that a person should be having in terms of the amount invested that they should be. Now, please take a snapshot of this. Take a look at it. Take a look at where you are. Now, I also wanted to now start going into issues pertaining to not just the wealth targets, but also to do with the wealth. I wanted to go into the wealth levels specifically to do with savings for children's education. Now, there are 4 levels of children's education that we should be looking at. So you should be using the markets to save up for your children's education. And the 4 levels we look at are what are called local diplomas, local degrees. So in other words, a diploma in a local college, which is 3 years and usually costs about 75,000 kwacha for 3 years diploma. For local degrees, 200,000 kwacha is what you should be looking to save up. This is the total cost of education. Regional degrees, 770,000 kwacha. That's what you should be saving up, including transport, boarding, logistics, everything, including the education. And a global degree, you should have about 2.2 million kwacha saved up. This will just get you just enough. This is where they stand in terms of if you want to send your child abroad to the US, the UK, generally there. Now, these are the savings rates. These are the savings rates that a parent should have. So here they are. These are the amounts of money that parents should be saving and investing on a monthly basis in kwacha in order to be able to reach these targets. So as you can see, the blue one, that's your local diploma. As you can see, when your child is born, that's 165 kwacha per month. If you want to try and get to a local degree, we're now looking at about 441 kwacha per month. You should be saving from the time your child is born. If you want to try and send them regionally, you should be investing 1,698 kwacha per month if you want to take them regional. If you want to take them global, you should be saving 4,852 kwacha per month. This is from the day they're born all the way up to the age of 20. And if you see, if you start them at age 4, then we're looking at 237 kwacha for a local diploma in terms of saving and investing per month. By the way, these are recommended monthly investments to target each type of education for a child. Recommended. Okay, I'm gonna say that again. It's not a promise. It's a recommendation based on our mathematics and our understanding of how the markets work. Now, 632 kwacha will probably get you towards a local degree. 2,433 kwacha saved and invested every month from age 4 to 20 will probably get you to a regional degree, and 6,952 kwacha saved and invested in financial instruments is what you can use to target a global degree. And if you get to age 8, it's 361. 962 for local degree, 3,703 for regional degree, and 10,580 for global degree. And if you now start getting to age 12, 615, 163, you can see these numbers are picking up. Obviously, the closer you get. And if you start when your child is 16 and you're saying, look, in the next 4 years, I need to save for their education. Well, the question is, can you save while still saving for your retirement, by the way, because don't sacrifice your retirement and become their tax. Can you save 1,391 for a local diploma, 3,709 for a local degree, 14,279 for a regional degree, and 40,000 kwacha per month for a global degree. This is what you need to start looking at in terms of the amount. Now, if you're looking at lump sums where you just want to deposit money and leave it, you should be looking at having 23,000 kwacha from the day your child is born for a local diploma, from the day they're 4, 30,000 kwacha, 37,000 kwacha at age 8, 47,000 kwacha at age 12, and 16,000 and 59,000 kwacha by age 16 in order to be able to cover them getting a local diploma. If you want to cover a local degree, you need to put 62,000 kwacha into your investment accounts for them by the time they're born, 79,000 kwacha by the time they're 4, 99,000 kwacha by the time they're 8, 125,000 kwacha by the time they're 12. And then if you're looking at regional degrees, By the time they're born, you should have 240,000 kwacha put into an account ready for them, into your investment account. When I say an account, I'm talking about, have you invested it in stocks, bonds, unit trusts? Have you put it somewhere there? My advice to most people, by the way, fixed income, unit trust, and bonds are your friend when saving for your child's education. You don't want any risk attached to it. 303,000 kwacha for a regional degree by age 4. 383,000 kwacha invested into an account for a regional degree starting age 8. Starting age 12, 483,000 kwacha. And starting age 16, 610,000 kwacha. And if you want to send your child global, by the time they're born, you should have 686,000 kwacha sitting in an account, 866,000 kwacha sitting in an account for age 4. 1,193,000 kwacha at age 8, and 12,000 and by age 12, 1.3 million and 1.7 million sitting in an account by age 16. These are some of the math that we have. Now, these are not guarantees. These are recommendations that you have when sitting with an advisor such as myself, whenever you're trying to do child education savings. This is the data from what we have now. As I said, we have lost Vernon for the moment, but we wish you all a wonderful day. God bless to as many of you. And we will see you tomorrow when we give you the roundup of what has happened from the central bank meeting. Good day.